Hey traders, Nick here, recapping the week early, just so we could have something to do for somebody who's not watching the markets today. So, interesting day. I'm going to start with a recap and then we'll look at charts. I'm doing it this way because I was asked to, why not do it in the form of a presentation? Let's see if it works. So, it's actually today's, I want to retest the macro, my thesis, okay? Is it still valid? And, I make comments every day. Are they still valid? Okay, this is as of 323. All right, so the thesis currently is that the Trump trade has a lot going for it, or at least had. Infrastructure spending, walls, etc. And also that I'm going to include, the tax advantages brings companies cash, so companies are going to do some spending themselves. So it's not only fiscal spending from the government, actual, private sector spending. It's going to trickle down. Looser regulations, especially for the bank. So basically, most importantly, I think we had a chief in charge who is actually a businessman who should love the stock market. And he actually did love the stock market. All right, so that's the thesis, that companies are not bloated. If you look at Apple, 18, 19 PE, maybe lower. Micron today is getting shellacked. It's 9 PE, 9. Yeah, I don't care how fast it's come to here. It was mispriced. So anyway, this is trailing PE. Google, Facebook, all of these guys are like 20s, 30s. They're not bloated. These are actual trailing 12 months PEs. So that's the thesis. Okay, so what's going on? We have challenges. Sentiment. It's basically, we have a crisis of sentiment right now. And the president seems oblivious to the stock market. Yep. He's amassed a team that is very, very aggressive, and they're hardliners. So now his team looks like him. Tariff threats offsetting the enthusiasm, so now we can focus on nothing but the headline. Oh my gosh, this and that. Fiscal spending, tax advantages, never mind. It's all bad. So fiscal spending, infrastructure is no longer so obvious. I mean, he talks about the wall today, $1.6 billion spending for the wall. That's good. But the infrastructure spending is still a theory. I haven't seen any concrete stuff from it. Rising rates, fears, suddenly. I say fears because we knew they were rising. I mean, it was part of the thesis. That was part of the thesis, why banks are going to do better, etc. So we knew they were rising. But more importantly now, nobody's yet talking about it, is LIBOR. LIBOR, that worries me a little bit. If it goes out of control, lots of mortgages, including mine, tied to the LIBOR if they're variable. So if I have to pay more for my house, I'm less likely to spend more somewhere else. So do I change my thesis? Not yet. I don't say no emphatically. I say no, not yet, because I have to be open to changing my thesis, because I don't want to be wrong and fighting an upstream, swimming upstream. So the question now becomes, are these threats that we just noted temporary or permanent? Okay, so if they're temporary, I don't worry about them much. I go long-term and trade my long-term valid long-term trades. But if they're temporary, then I have to worry. Permanent, I have to worry. Okay, so far I believe that they are temporary, but they have definitely lasted longer than they should have. Okay, but there we are. We've had one headline after another headline after another headline, even this morning. Okay, so not surprising. So the headlines are relentless, and so the VIX, the fear, the VXX, whatever you're watching, UVIXY, they have no time to die down. They're just boom, boom, one after another, one after another. I will revisit this weekly to see if there's a material change. If I know that the president is going to be doing this for a long time, then I have to worry about that. And I can't just keep the blinders on. Okay, so I have to be open. I made that mistake once. I stayed short too long, and I don't want to do it again. It was just not healthy. All right, so meanwhile, what do? I have to watch out for a whole bunch of stuff. So because we have threats, right? We talked about tariffs and all of that. So there are some threats and companies in danger just from the tariffs. Let's start with the tariffs. Anything that has to do with China, Baidu, Baba, come to mind, Tencent, anything that has to do with China. Okay, so also industrials, because they said we're going to stop doing this and stop doing that. So Caterpillar and Boeing are the two that have been taking it on the chin. However, Boeing, I think, is green today. Caterpillar is also green, but barely. But it's been like selling hot and cold, hot and cold. Okay, so any bounces are not holding. That's because of fear. So don't chase upside potential until the VIX dies. And I'll remind us a little bit of that chart with just 3 things we're watching for. We want leaders to lead, like Apple, Google, laggards to stop falling, so stabilize, and fear to die. None of these is happening. They can't. I just tried to catch a breakout several times today, and it happens and then it fades. They are not. There's no follow through. So until at least 2 of these are happening, I don't think they will happen without fear falling. So I'm going to say all 3 have to happen before you can buy upside hopium. Until then, this is just a hunker down, and I'll tell you at the end how do you hunker down. All right, so FedEx is also in the line of fire. I bit too soon on it, and I regretted it. That was a loser for me. Apple is in the target too because it's easy to hit with the iPhones, but they haven't named them yet because Apple is playing their game over there. It's playing nicey-nicey. Google is not in the line of fire because they officially exited the China market, but they're under fire from Facebook. It's a, quote, social media, and Facebook has just poo-pooed all the social media. Somebody said yesterday, this is the end of social media. This is the top of social media. Are you kidding me? How can you say that? My son has nothing but social media. He doesn't have any email address. He doesn't use his phone. He doesn't make phone calls. Strictly social media. There are whole generations that know nothing but social media. And the whole rest of the world is going to catch up to that. And this guy, an expert on CNBC says, this is the end of social media in so many words. Okay, so housing, higher rates, slowdown, etc. So you see there are a lot of companies in the line of fire. That's why the risk is real. Okay, so next week, we don't have anything scheduled that is inflammatory. We do have GDP, I believe, and PCE, so we can get some chatter about prices. So is it inflation or not? And GDP, or how well are we doing? And so send me a list of tickers that you want to analyze. I got a few today, so I'm going to share another video later, maybe over the weekend, of things to do with the certain companies that I was asked about. Meanwhile, if I'm already long, I have to stay protected, meaning I have to buy puts in the indices, or I buy calls in VX, VIX or VXX. Because if we can get to the lows of the February lows and beyond in hours, we saw last night. Last night the low was 26.16, I think. We came close to it twice today, and we're headed towards it right now. Markets were just green seconds ago. Now they're back to red. So there's nothing sticking. Fear is rampant, and until that dies, I cannot chase upside. Okay, so I can buy puts, easy puts, SPY, Qs, depends what I'm long. If I'm long tech, I'll go long puts in the Qs. If I'm long, just regular stocks. If I'm long Cat and company, those are Dow. So I would definitely buy puts in the DIA, for example. That's easy. And what timing? I would buy them out in time, say 3 weeks out. This way they don't lose their value like right away if they don't hit there. Okay? All depends on the portfolio. That's how I hunker down. So again, the thesis is not broken yet, but man, is it challenged, all right? So having said that, I'd like to show us some levels. Hopefully let me know what you think of this format. Okay, so here is today, the S&P, all right? So we opened, overnight it was pretty ugly, and then we opened down, and then we tried to recover. So I'm going to go to one day, the daily. This is what we're used to seeing. In fact, I'm going to switch to the SPY because I've been sharing it because I drew arrows on it. Okay, so this is the February low. And, I said we can't lose this. We did. This is about the target area for it. But I said if we lose this might trigger this. So that's why I said we can beat the February lows in the blink of an eye. So I can't play chicken with this, people. There should be support, but don't count. Panic is panic. This is not panic yet, but the fear is not dying. I am still optimistic, and I say this: if the headlines just go away, we will be at all-time highs in no time. That is my thesis, because the numbers are just too low. Why would you sell Micron at 9 PE? Now less, because it just fell 5-6%. Okay, so yes, but if you look at it on a chart, look how far it came. Well, obviously it was mispriced here. So I went long Micron by selling puts. I sold puts at 40. So I said, even if they want to bring it back to here, I'll buy it here. And I collected, I can't remember, over $1. Anyway, so I'm just saying as an example, Apple. Here's a question. Will people buy Apple at 145? Will they? I think they will. So there's no reason why the dips should remain down there unless we have a game changer. Okay, so the levels are scary, yes. I'm not minimizing the threat. Technically, we need to hold this, otherwise we will find new lows. And maybe that will be the wash that everybody, all these experts on TV that keep saying, we need to retest the lows, retest the lows. Well, we fell, you know, whatever, 11% here. Okay, so this is 7% from here. So, and definitely 10% from the highs. So, you know, we've had a couple of good corrections in not too long of a time. That's not good enough for them. If I was a gambling man and I say, okay, I need to leave, I can't trade for a few months or a few years, then I will buy calls in Apple in the money or at the money and go on vacation, because down the line in a couple of years, Apple should be higher. That's my opinion. So, but for now, what I just said in the presentation stands, and I don't take silly chances. IWM, that is the small caps. That is a representation of something that doesn't have Facebook in it, that doesn't have any direct input from Apple math. Okay, the Qs, that's the NASDAQ. 0.2 of it, 0.15 to 0.2. If Apple drops 1%, this will fall 0.15% just from Apple. So if Apple falls, then this one falls a lot faster. Look at all these open gaps they've left. This is not normal. Yeah, I'm going to go back in time. There's no open gaps like that. So this is fear. Okay, so you pick your levels, but for now it is totally okay to hunker down until fear abates. We have not had hours without headlines. Friday is perfect day for headlines. So I'm going to sign out here so not to make the long video. If you have any questions, let me know. Nick signing out.